Good day, high flyers, and welcome to the Aim High podcast. I'm your host, Bud Evans. Today, I am here with Flint Jamison. Flint, how are you today?
Hey, doing fantastic. It's springtime. The sun's out and deals are happening.
And you know what? A couple of things, man. First, we should be outside walking and having this conversation.
That's
Second,
true.
yeah, absolutely. I love walking properties this time of year when all the weeds are surrounding them and you can just see, oh man, your landscaping needs this and this. It just makes it so much easier.
Yeah, you do see, yes, the problems are much easier to find. That's for sure. When it's not buried in snow.
Absolutely. So, Flint, you and I have a lot of people in common in our network. Can you do me a favor and just give me a brief introduction, real quick?
Yeah, so Flint Jamison, I own a real estate investment firm. I largely partner with experienced operators around the country to bring my friends, family, and investors really great deals in the commercial real estate arena. So I'm a syndicator. And I started out in aerospace. I'm an engineer and 20 years in aerospace. I designed parts on the Boeing 787. I've modified aircraft for the military. And here I am, full time real estate.
Awesome. So we have that kind of going for us, or we're both from I'm from the actual support side of the DoD portion of the aerospace industry. Other than that, man, so you're an engineer and you're in aerospace design, and all of a sudden now, what was it? The numbers? What got you into real estate?
I I think I got started like most people, where you just think about how can I invest my money differently outside of Wall Street? And you hear about people owning single family homes and, somebody's rich uncle who has passive income because of a massive portfolio of property. So I was like, okay, let's go. And I bought a duplex in 2018. It was a heavily distressed property, renovated it, I held it. So I did the BRRRR strategy. The BRRRR strategy wasn't totally successful, but I held on to it. I made money and sold it 3 years later. I actually sold it in April of 2022 before the market went down. It's just serendipitous, good timing.
Okay. Now you got a single family duplex, right? So
Yeah.
residential multifamily. What made you take the next step?
Yeah. So I realized after I tell people, if you want to buy a single family home, just expect you're buying yourself a job.
Yeah.
And this was remote. I'm in Denver. This was in Milwaukee. And I had basically found the team to do all the work, but it took twice as long to get it up and running, cost 30% more than anticipated on the renovations. And then when it was all said and done, I was making $300 a door, so $600 a month, which feels really good from a monthly perspective. And if you look at what I've been told, I guess Bigger Pockets Forum, this number pops out in my head. They said on average with single family homes, you make 200 a month. And so I'm
Mhm.
like, oh, sweet, 300 a month per year. I'm killing it. But if I wanted to retire on a portfolio of units like that, I would need to do that 50 more times. Like, geez, I just can't wrap my head around being able to do that. And this one wasn't 100% success. I didn't lose money. I was making okay money, but I was like, man, I'm going to have some duds in there, maybe some successes, but this is going to take me forever because I'm running solo and it's a lot of capital. So that's when I started looking, what's next? There's house flippers. A lot of people like to go from single family home to house flipping to wholesaling. Eventually they end up at the holy grail, what I call syndication, where you can passively invest, or if you choose to be on the active side, like myself, general partnership, team up with a bunch of experts, and we take down massive properties. And there's a lot of scale to it and much higher potential.
Yeah, man. So let's talk about your first commercial multifamily deal. What did it look like? And how did you get into it?
it it looked like failure. I got my first failure out of the way. It was a 23 unit here in Aurora. It actually ended up being 22 units legally, but to give you the longer story, just for your listeners, partnered with some other newer syndicators like myself. We were a new team. We figured, hey, we'll bite off this small chunk, which is a 23 unit. We found a property manager in town who would partner with us. They're like, yeah, we can do it. And they had their own internal, they were vertically stacked with their PM and general contractor. They did all the bids. And then at some point, 2 weeks to closure, or 2 weeks before the money went hard, or earnest money, They ghosted us, and we have no idea why. So we quickly turned around, found a bigger property manager, a nationwide operator that could really come in, and man, it was a game changer bringing them in. But a bunch of things went wrong on on that, but we did find out the 23rd unit was in the basement and it couldn't legally be used. So we're like, dang, that hurts the numbers. When you subtract one unit on something that's 23 units,
Yeah.
it hurts the numbers big time. So we were trying to find other ways to recover some of that money, amenities, whatever, in which way. And our property manager was helping us through that. But in the end, we couldn't raise enough money. And that was, we just had to back out. And we paid a lot for the earnest money. It was I believe it was $2.1 million purchase, or 2.9. I can't, that was back in 2021 at this point. But yeah, I lost $30,000. So I say I got my $30,000 mentorship through the School of Hard Knocks versus paying a guru. But from there, I took that weakness of capital raising, doubled down, paid a coach, built my systems. Within 3 months, I got invited with an experienced group to help raise capital and work with them. So the failure happened in August. By January, we closed on my first successful deal, and it was 104 units.
Great. Now, okay, so I'm smiling, but I'm not like, it's not laughing. It's more like something that you said that I say all the time is sometimes the best education that you pay for is not a college. Right? So,
Yes, it's
like
true.
when you have a loss in real estate and you lose a little bit of money, you just chalk it up to an educational experience and move past it, right?
You have to, otherwise you just may quit the game in its entirety.
Let's talk about a positive aspect. What was that 100 unit like?
It was a breath of fresh air. To be honest, it's funny going from a 23 unit to jumping on with this experienced team and bringing my investors a, a property that had a team with a history and experience. It's just like a lot of the weight was lifted off my shoulders and on a bigger team of people that had more capability to make something happen. So it was like slapping training wheels back on me. And to be honest, when I switched over to this capital raising thing, it changed my course, because when I was doing this local, I was the only boots on the ground. I was doing all the due diligence inspections with all the GCs, I was doing some of the underwriting, right? I was taking on a huge load. And with these guys, I was more shifted towards capital raising. I realized when I was in my W-2, I could do this remote. I can be a capital raiser remote. It's hard to do acquisitions remote. It's hard to be asset manager remote. But capital raising, I was like, oh, this is a sweet gig. Maybe I'll continue doing this, and then I can partner with other operators too and bring a diversified portfolio.
Yeah. Great point too. Not being able to be the boots on the ground, you really you'd have to really stretch yourself thin to be able to go back and forth to find a place.
Yeah.
But now, what are you working on now?
Oh, several things. We're about ready to close on this coming up this Thursday, which is, as a recording of this is 4 days from now. A 94 units townhome community in Columbus. And then on top of that, I'm partnering with a team doing build to rent. So I'm doing new development.
Ooh.
There's 3 properties. There's a 90 unit, a 160 unit, and a 240 unit. These are all brand new development, single family home communities built to rent, as in it is a commercial property rather than apartment buildings the tenants live in, like basically a starter home. And we have on-site property management, maintenance, amenities, pool, and all that. So it feels like a Class A apartment complex with your own starter home.
And not something that you hear about happening every day. Having a
Which
bunch
is,
of
yeah.
single
And
family.
here's the crazy thing is this build to rent is gaining a lot of traction to the tune of hundreds of billions of dollars from financial institutions like BlackRock and some other very large financial institutions are throwing their money to buy these communities, but they don't build. So
Right.
we're building it for them. So our goal is to be the developer. We'll stabilize it for, say, a year and turn around and sell it. And it's a huge yield on cost play from an investor standpoint. There's no cash. This is the thing from investors. When you go do a value add, there's likely some sort of cash flow
Mhm.
throughout the years. You're still doing value add, so it starts out pretty low. But on this one, you have to expect there's no cash flow for probably 3 years. And then wham, you get cash flow. And then maybe a year later, you get this major profit at the sale. It's a great asset class. Lots of demand.
Great. Let's talk about what you do with that profit.
Turn around and reinvest it.
Right.
Yeah.
A huge taxable event, though, right?
What's that?
It's a huge taxable event. Is there a way to roll that in? Is it like a 1031? Is there a specific code that you use or a specific way that you do it?
Oh, that's such a great point. So there are so many different plays you can make. And yes, you could do a 1031 exchange as a group between the GPs and LPs, or the LPs that want to, and do a 1031 into a new property of like kind property. This is where we're starting to go down a rabbit hole that my expertise is not on 1031s.
Okay.
I think I'm dangerous enough to talk details, but I could get myself in some danger here. But here's the crazy thing. There's other exit strategies. We've been talking, these assets are so hot, not only just to sell to some financial institution in the end. We could just cash out refi, give everyone their initial money back. It's like the Burr strategy, only we're developing. We get all of our initial money back, and then we cash flow with infinite returns for as long as we want, maybe up to 10 years, and then sell. There's another exit where we could sell these, depending on the economy, in 5 years. If we have to, we have single family homes. We could sell them individually. That is not the goal. We want to sell it as one big commercial property. But if we have to, we still have a whole lot of value out there on that land that we can sell off. To your point, though, the capital gains. Yeah. I like to turn around and invest into another property, whether that's 1031 or just taking accelerated depreciation from just investing in another property. So you can go either way.
That's great, though. You're giving yourself a whole bunch of different options that, you don't really hear about all the time.
Yeah. Yeah. And actually the return on capital, let's point that out. If during one of those cash out refi events and you get your original capital back, that's not a taxable event because we are simply giving investors their original money back. So you're just like, thanks for that. And then you go turn around and reinvest it and you get more depreciation off of that same dollar while you can still be writing out that original property for cash flow.
Because it's just equity.
Yeah.
It's not actually cash. It's not income. It's not capital gains. It's just, we refinanced, took out the equity, and now we're using that and deploying it someplace else.
Yeah, exactly.
That's awesome. That's a great system. I love it. So where's the fund? Do you have a fund how do you capital raise? How exactly?
Okay. Now we're opening up another rabbit hole here. So
okay. Yeah. I don't want to put you on the spot. I don't know exactly how this is it's being funded, 506B, C, whatever.
Oh, okay. So and the reason why I say this is a rabbit hole is because, and I love talking about this because there's so many ways to get into investing as a passive or general partner. The money comes from what we call just retail investors, just anyone out there who is qualified enough to invest $50,000. Yes, 506B or 506C. We do take accredited and we also take non-accredited. The deal has to be specifically set up one way or the other from the beginning. But if you want to get in on any deal, the best thing that I recommend, if you know any syndicators, find a syndicator, get on their investment club. That's what we call them. It's really getting in the database. You have to get to know them because that's the only way you're going to find these deals. A lot of deals happen, especially the 506B for non-accredited investors. All those happen behind the scenes. Those don't get advertised per the rules at SEC. They only go out to the database. Accredited investors can invest in those deals too, but it's like an email blast and phone calls. You magically get called up. Hey, we have this great opportunity, and no one else knows about it other than the database of the GPs. So to talk about, because you mentioned fund, and this is where I like to talk about opportunities. So I did a fund of fund, hopefully not to get things too complicated, but it's basically there was a really large $50 million fund that went and purchased three properties, three different operators, two states, three different cities, two different asset classes. So it's basically one $50,000 investment gave you three properties. And part of that $50 million fund is the person that's running that big fund couldn't raise all of it themselves. So myself as a capital raiser, I can create what's called a fund of a fund. And then I raise million, 2 million, whatever I can bring in. And my investors, it's blind to them. They put in their money and they're invested across these three properties. Behind the scenes, we're building the legal structures in place. So there's fund of funds. There are blind funds where you can get in. I'm in one passively, 8 properties are in it. I don't actually know how many units, how my distribution is. All I know is I'm distributed across 8 properties across the US. There are evergreen funds where I call it your choose your own adventure. And I hope to do this as a capital raiser someday. But I can just bring within my portal, I can just bring in a new property this month, bring in a new property next month, and everyone who's within my ecosystem can be like, oh, I like that property, and just choose to invest in it because they're within this ecosystem. So that's choose your own adventure. The best part is as cash flow starts coming back from these properties, it goes back into that fund, into your individual account. And if you're getting $3,000 every quarter and you can't invest into the next deal until you have $50,000, well, those $3,000 each quarter is not doing anything other than sitting there. Mm-hmm. So then we can bring, per the evergreen fund, choose your own adventure, I can bring short-term debt. I can bring hard money. So this is just put it in there for 90 days. It's illiquid. After 90 days, you can choose to pull it or you can keep just feeding it. So those $3,000, you can just keep throwing at something that's like an 8% return. Hard money.
That's awesome. See, Flint, there's a reason that we got together on this call. Listen, there is so much value add going on right now because you are basically teaching all of the people that are listening or watching on YouTube exactly that. It's not just about there's one type of real estate that you can invest in. There are so many different ways to invest in real estate, and you're just blowing my mind right now with the amount of information that you're giving. That's awesome. Thank you.
Yeah. And not to mention, it doesn't have to be apartment buildings. It could be self-storage. It could be industrial where you start getting into triple net leases. You could do retail triple net leases.
Now you're saying one of my favorite terms.
Triple net, yeah.
Triple net.
I haven't done one yet. I am geeked to find a partner to do that with. I'm also really excited to find a partner to do self-storage with. So that's the other part of me being a capital raiser. My investors can get these options versus as an investor, you want to invest with the person. I'm just going to use the person that's the expert in Class B value add assets in Dallas Fort Worth. But if they are the only operator, you're only investing in Class B assets in Dallas Fort Worth versus I can find those operators to know and trust who have that track record. I do the background and then bring investors into it. So yeah, it's a fun position to be in.
Excellent. So I've got to ask you now. So you've done all of this stuff. You've raised all of this money. What is one thing that you've learned as your wealth has increased?
So my whole goal has been to, one, exit from the rat race, my W-2 job, and spend more time with my kids. So they're 4 and 6, soon to be 5 and 7. Now I'm working from home. I'm working for myself. I can take PTO whenever I want. Kids got no school on Friday. What are we going to do with them? I'll just hang out with them. I just have this freedom to be with the family. And I think that's what matters most.
I agree. I agree wholeheartedly. Just spent the entire day with my wife for no reason other than it. Why not? It's Monday.
That's awesome.
Forget about it. A former employer would never have let me do that. So yeah, great point. Okay, Flint, we are going to go into the Soaring 4. These are the same 4 questions that I ask every guest that might help a new aspiring investor achieve new heights. So question number 1, is, what is one thing that you use to keep you motivated?
God, there's multiple things, but one thing I find it really helpful just to get up and walk. We were talking about it, like a walking meeting. I walk my dog every day after lunch just to get away from the desk because, the desk is a grind. I got out of the rat race to get away from the desk and get
Yeah.
away from the grind. And you can very easily do that to yourself as a solopreneur. So you got to change your lifestyle a bit in order to keep your mind active.
Great. What is one thing that you learned that completely changed your mindset?
Uh, what I found getting into syndications was something that was way different than what I had originally anticipated. I thought I was getting into syndications just to get on this great financial wealth roller coaster. What I found was a group of people, a network of people who are super driven, who are always trying to provide value in life, who are, to be honest, it's just people who are motivated with energy. You go to these conferences and you're amazed at the background of everyone. You have school teachers, you have firefighters, you have people from all walks of life who are now like, you know what? I just want to do real estate because I can do life by design. And this is providing it. Real estate is the vehicle. It doesn't have to be sexy, but what it provides is something so amazing. And I think that's the thing that I discovered unintentionally. And that has changed my outlook because being around these people has totally changed my mindset.
Excellent. What is one thing that you use to keep you on track?
I am not good at that yet. Like time blocking, all of that stuff, putting down tasks, I'm still trying to figure it out. This is one of those things you always hear about. There's always these hacks. You can use Asana, you can use this, you can use that, but not everything works for everybody. Sometimes you just have to fight through life to figure out that one thing that works for you. And to be honest, I'm just still fighting through it.
Awesome. You know what? It doesn't matter. Time blocking and all that stuff is perfect, but there's always a distraction anyway, right?
Yes.
So great. And what is one thing that you would change if you had to start all over?
Take action. Take action much sooner. So even in the single family world, you think that you're going to try to educate yourself to know everything before you jump.
Mm-hmm.
You're never going to know everything. And then you get in your mind and that voice in your head is, you're still not good enough. You better go learn more, or you don't have what it takes. So you try to learn more, and then you'll just be in a perpetual not doing anything. Take action. If you want to get into syndications, the best part is you're getting with a team of people who are experts in their own right, and they're hopefully complementary. So you only have to know so much. Just jump, just get in it. I would be in a much different spot in my life right now had I acted when I could have acted probably 2 years sooner.
That's awesome. So I'm just going to say this real quick because it's something that I said during one of our webinars, our weekend webinars. Having a W-2 is easy. All you got to do is show up and basically just follow the simple rules and you can make it. Like getting out of the W-2, it's tough. You've really got to want it. But oh man, there are just, anyway, I'm just going to stop it there. And I'm going to say that that's a lot of value. If somebody wanted to reach out to you, Flint, how would they do that?
Yeah, there's a couple things. Investwithflint.com. That's the easiest to remember. It'll take you to my company, vestiscapital.com. Or just jam with me on LinkedIn. It's LinkedIn/Flint Jamison.
Outstanding. I will make sure that link is in the show notes. Flint, thank you very much for the value add. I really appreciate it. It is a lot of information in 25 minutes. So I appreciate your time. I know you're busy.
Yes, thank you. It's been a pleasure.
Great. If you want to get in touch with Flint, check out the show notes for his link. Until the next time, this is Bud Evans signing off. Aim high.